In the dynamic world of technical analysis, reversal patterns such as the double top and double bottom stand as beacons that guide traders to potential trend reversals. Understanding these patterns in depth is key to successfully navigating the financial markets. The double top, a bearish pattern, occurs when the price makes two consecutive similar highs, followed by a drop below the support level that links them. This pattern suggests an exhaustion of the uptrend and the possibility of a downward reversal. The formation of these patterns is based on market psychology. In a double top, the first peak reflects traders' optimism, driving demand and raising the price. After the first peak, a pullback occurs as some traders sell their positions for profit. This causes a decline in price. The price rises again and forms a second peak, which is similar to the first peak. However, as the price attempts to break above the level of the first peak, demand weakens and sellers begin to dominate. The price cannot break the resistance established by the first peak and falls back to the neckline. The neckline refers to an imaginary line that connects the low or high points of a chart pattern. The final stage occurs when the price breaks the neckline formed by the lows between the two peaks. This break is a signal that the previous uptrend has ended and a bearish reversal is expected. The break of the neckline can trigger further selling by traders, resulting in a significant drop in price. The double bottom formation also works in a similar way, but in reverse. First, the price reaches a low reflecting distrust and pessimism. Then, a pullback occurs as some traders buy to take advantage of the low prices, which generates a rise in price. The price falls again and forms a second valley similar to the first. Traders assume that the price will rise again as it did in the first valley and enter the market with buying. Demand begins to outstrip supply. The price rises and breaks the neckline. This break may trigger more buying by traders, which pushes the price even higher. To facilitate the identification of these patterns, you can use custom indicators that automatically identify and draw the lines of the patterns on the chart, saving time and effort in the analysis, such as the indicator called double tops and bottoms, which can be found in TradingView by the user QuantView. The indicator employs the concept of pivot points, strategic points on the chart that mark changes in price direction. These points are used as the basis for identifying the relevant highs and lows that make up double top and double bottom patterns. Once the pattern is identified and confirmed, the support or resistance line of the pattern will be drawn, green for bullish patterns and red for bearish patterns, and an arrow will be displayed in the direction of the expected movement. There are two ways to take trades with these patterns. On quick entry, we enter when the price reaches the pattern's neckline. Classically, the stop loss is positioned above the neckline if it is for sales and/or below. If it is a buy, this placement provides basic protection against adverse price movements. Slow entry. For traders looking for further confirmation, wait for the price to break the neckline and then return to touch it, confirming the breakout of the structure. Then the stop loss is placed a little closer to the neckline. While this indicator can be useful, its signals should not be taken as absolute. Trading decisions should always be based on a more complete analysis. This indicator is a complement to your analysis. Combine it with support and resistance, trend lines, and other indicators to develop a sound trading strategy.